Listen, let's talk about Citigroup. Citigroup might take a hit, might take a big hit on their Smith Barney venture when Morgan Stanley starts buying some of that back. Colin Barr is here with details on that one.
Right. Well, so they set up this venture a couple of years ago. Actually, in 2009, as Citigroup was trying to get out of the worst of its problems, and Morgan Stanley had been kind of they got some federal help themselves during the crisis, and so that made
it's a very diplomatic way of putting it.
Right. And so that made both of them say that they needed to change things a little bit. So Citigroup wanted to get rid of things that it wasn't focusing on, and Morgan Stanley wanted to change from being a pure sales and trading shop to being a wealth management. Right.
So they formed a joint venture, and now they're looking to unwind it.
Right. So Morgan Stanley has the option over the next couple of years to take full ownership of it. Morgan Stanley currently controls 51% of it, but this spring they have the option to buy another 14%. And so what we're looking at here is that the two sides have different ways of accounting for this venture as a result of the different things they contributed to it.
And you're talking about when you look at how Morgan Stanley values it on their books,
right.
You're talking about billions of dollars
pretty
difference
big gap,
there.
Pretty big gap, right? I mean, one analyst who's looked at this says that the way it looks to him, Morgan Stanley's valuing Morgan Stanley Smith Barney at about $15 billion, and Citigroup's valuing it at about $20 billion. And one aspect of that is that these guys had pretty big hopes in 2009 when they set this out. They said, this is going to be best in class and it's going to be peerless, and all those things that they say in press releases. And then in reality, what happened is that the market has gone nowhere for the most part. And we're up at 13,000 now, but it's been a long, slow climb, and a lot of people have been sort of scared out of stocks by things like the big crash in 2008, and then you had the flash crash. And there have just been a lot of things that have sort of reduced people's interest in buying stocks. And so the wealth management business is not growing the way they anticipated, and so that supports a lower valuation for it. There's no two ways about that.
So in the story, there's an analyst, Mike Mayo, who's basically questioning how Citi values its assets.
Right.
And maybe not necessarily just this one, but just assets in general, which seems like a wide sweeping.
Right. Well, of course, Mike is not the biggest fan of Citi. He doesn't have. I don't think he has. I don't think he has like a big cardboard cutout of Vikram up in his office or anything like that.
Doesn't have a fat head on his wall.
Right. I mean, he points out that they've had their issues in that area in the past, and they. I think that there's a sense that Citigroup is approaching things a different way, but everybody remembers how big the write-downs they were in the crisis were. I mean, there were billions and billions, and that is why they were the biggest bailout recipient. During 2008 was just that the Chuck Prince quote is when the music's playing, you gotta keep dancing.
Is there a sense of who maybe has the more accurate estimate of what Smith Barney is
and
actually worth?
that's going to be an interesting thing, is to see how this plays out. I mean, I think that the fact is that Citigroup's estimate looks to a few of the analysts that we talked to, Mayo, for instance, and Howard Chen of Credit Suisse, looks a little more aggressive to them. I mean, I think that people are of the view that, look, this thing may have supported a valuation of that size a few years ago, but now we've had a few years in which income has come down. There's not a big push for people to get into the stock market, and I think it's plausible that the lower valuation is better.
Now let's pull up there's a Citigroup stock chart that's for 5 years and see it falling off a cliff. When they do this deal, Morgan Stanley has this option. Can Morgan Stanley set the price, or is there going to be a big negotiation? Is this going to end up where Citigroup is just forced to take the loss?
Well, I think that I think both sides have a lot of incentives to get a deal done, because Morgan Stanley wants to take this thing back in house, and Citigroup wants to get it off its books, and even if they do have a sale at a valuation below their valuation, this deal is arguably still quite good for them because of the way capital rules are. They could actually get a big capital relief on this. They don't have to hold any capital against Smith Barney once they've gotten rid of it. So that's a big consideration. You see a lot of deals these days that are being driven in part by the fact that everybody can see that these capital rules are coming into effect in the next couple of years, and they have to get their capital up. We actually saw this with Morgan Stanley, where they did a deal with MBIA that looked like an accounting loss, but it was actually good for them from a capital standpoint. And so that's something we're going to see.
That's right.
I mean, the viewers are all asleep undoubtedly already with me talking about capital. This is
not exactly. They're following.
Not exactly driving eyeballs. But I mean, that's an important issue here. Is that these guys have there's sort of a short-term pain gain aspect to it. Yes, this is a write down. It looks bad. It makes our earnings, reduces our earnings. But by the same token, it puts us on the right side of this capital calculation, which you just have to be. You have to be on the on the right side of that. So.
All right, we're going to leave it there.
Great,
Colin
thanks.
Barr, thank you very much.